content of this podcast is produced for entertainment purposes only and is for informational and educational use. It does not constitute financial or investment advice. You should not make any financial decisions based on the information provided without consulting a qualified professional. All opinions expressed are solely those of the host and guest and do not reflect the views of any company or organization. The hosts and or guests may currently own, have previously owned, or intend to own securities discussed in the content. The content produced here belongs to Daniel Andreev of 18 Degree Journal and cannot be reproduced or used without prior permission. We do not wish for this content to be used for AI training and do not give such permissions. Hey everyone, hope you're all doing well. Today we have a write-up about the arbitrage opportunity in Mount Logan Capital, stock ticker MLCI. I hope you're all doing well. And the subtitle, of course, for this episode is an interesting arbitrage opportunity with some downside protection. So again, hope you're all doing well. I finally finished my review of the lumber mill industry and some of the lumber mill businesses I was interested in. At this time, only one company really caught my attention and that I thought was really worth following for, though many of them, I will say this, are selling at distressed levels. I did put one of them on my list, as I said. However, I didn't acquire it or decide to write about it because I don't feel I have enough of margin safety on that business. Especially right now with a lot of pressure on it, I don't feel comfortable taking a stake in them. Whether it's a mistake or not is yet to be seen, but I may publish the write-up of the company if the price drops, and I think with the current US-Canada dynamics, that is a very viable possibility. Or if my understanding of the business simply changes or evolves in a way that I can wrap my head around paying the price that's currently trading for. However, since I did give you that whole write-up background, I was teasing it here and there, I decided to give you a little hint about the company that at least I found interesting. And perhaps maybe you'll be more interested in the industry itself. So the company that kind of caught my attention is a sub 1 billion market cap company. So it is a micro cap per se. Since I started researching it, and that was sometime end of November, start of December kind of time frame, it has already gone up over 15%. And you may be laughing because, of course, that's what happens every single time. It has operations on both sides of the 49th parallel. And I think at the moment around 4 billion board feet of annual capacity. It's also currently trading at significant discounts to replacement value, at least according to my calculation. So you may guess what that is, maybe not, but that's a wee little teaser. So today's write-up is an interesting arbitrage opportunity. And as I said, an undervalued company that does offer some downside protection if things really do go wrong. In the sense that you really don't get much fill and then the stock crashes, but we'll get all into that. But writing also by this opportunity, I may be shooting myself in the foot, as my instincts is to keep it to myself so I can accumulate more shares and increase, my chances of tendering my offer or more of it getting filled. But I decided you may be interested as well, and it was worthwhile. Maybe that there's a blind side I'm not seeing, and I could learn from this. So at least we'll learn in public. Before you go on, though, you should know that this specific opportunity will expire unless you execute before. So the date's hazy, so according to my brokers, two of my brokers, their deadline was January 29, 2026, 4 p.m. to tender your shares, which I'll get to. So, of course, the shares have to be settled in the NASDAQ as T+1 right now. However, we can take that with a grain of salt because I know in Interactive Brokers, they allow you to do it until 1 p.m. on February 2nd, but the official deadline, regardless of what the broker says, is February 2nd, 2026 at 5 p.m. This is where really IBKR's automatic system is shining and showing their competitive advantage. But regardless, which broker you are, you should do your own research. Full disclosure, additionally, that I do own a long position in this security. This is not intended to be construed as investment advice and for entertainment purposes only. Again, I do own a position, so full clarity. So quick explanation on the actual opportunity. So to not waste your time too much, I decided to kind of summarize it real quick, and I may be jumping out of place, but I swear it makes more sense, at least in my head, when you look at the actual article. So over the last little while, MLCI has undergone, we shall call it, a few restructurings and mergers, which have led them to now be listed on the NASDAQ, and this last development is sometime September 2025. To reward shareholders for their patience and for those who want to exit the company, the buying back approximately 50 million. So that's about 1.6 million shares. Well, to be exact, for those sticklers, the estimation, because we know the price they're buying is about 1.590600 shares, which is about 12% of the company, at a cash offer of 9.43 USD. So for reference, the shares have traded in January so far in the range of $8, so 803 to 860. I did scribble a little demo, and I could kind of put it up here for a second if you want to pause and look at it, but just quick display of what could happen. So if you get, for example, a price of $8.32, you will theoretically, if your shares get fully filled, that means that less than 15 million shares get subscribed to this tender offer. You will get a 13% return, and today is January 24th, and the offer expires February 2nd, and we'll give it 10 days-ish. So let's call it mid-February for fulfillment. So 13% in about a month is a bit less than a month is absolutely insane. But of course, most likely what's going to happen is you're going to have oversubscription of the offer, and you're going to get a proration. So probably a portion of your shares will be filled, and the rest will be back returned to you. And the risk there is that once people are not going to have the fills, and arbitrages will be exit the market, there'll be exit liquidity, which means there's going to be downward pressure for the stock, and you could have either short-term or long-term losses. And yeah, if you look at the scribbles, thanks for humoring and looking at them, but essentially, for example, if let's say double the amount, so 30 million shares worth of shares gets tendered, you get a 50% fill, so 50% of your shares get filled at $9.43, you get that profit, but then for the other 50% they come back, and you get downward pressure. I do think it's important to mention that this arbitrage in 943 is not arbitrage, it's what it merged with. It's the price it merged at in September, and at the time it was seen as, to the unaudited book value measurement, an 8% discount to it. So the book value was around 10. I'll get more into it, but it was a 10 something. I'll mention it in a bit. So yeah, that's something to keep in mind. So there's a few facts that I thought you should keep in mind. I couldn't really put them in paragraphs, so I kind of started listing them because I wasn't really sure how to phrase it, so bear with me. So unlike a lot of tender offers, this one's a little less retail friendly, as there's not only no odd lot priority, meaning if you own less than 100 shares, you treat the same as the rest. There seems to be a strict requirement for only offering round lots, so multiples of 100. I would take this as you will, though, with a big grain of salt, because I had to go through legal language myself, and I don't have all the training. And when calling my broker, they seemed to give me an option that if I wanted to enter only one lot, it could be an odd lot. But I decided to be on the safe side, and I think you should do your research yourself regardless. So that's something you should find out. The shares they are buying back will be all retired. I said it before, but you will be locking in your capital so until it gets back. So for the, call it mid-February, from the moment you tender them, you will not be able to access that. And again, you shouldn't trade on margin, but if you're in a margin account, that will affect your margin. It will affect your buying power, and it's something you should definitely keep in mind, especially if this turmoil. Yeah, it could not end super well for you. The board of directors have not given an official recommendation to what you should do. Important, as the $9.43 offer has come up as a base on the book value calculation in September 25, as I mentioned, discounted as the book value was $10.26. So that's the unaudited return. According to my calculations, I won't get into it, but I do think they did have a sale of assets, and I do think it is a little bit higher at the moment. Again, these are my assumptions. In Section 11, interests of directors and executive officers, there is a statement stating that we have been informed that none of our executive officers or directors or their affiliates intend to participate in the tender offer. For that reference, they own about 3.5% of the company, and we don't know how much else the affiliates are because they do mention affiliates. The CEO himself owns 1.7%, and they did confirm this also in the last quarterly call, where management also stated the management and affiliate partners will not tender the shares. If we believe everything else the management says, it seems to be one of two tender opportunities with an additional 10 million sometimes before September 2027. This is part of their 25 million shareholder liquidity exit plan. So 15 million of this is the first tranche, and the second is sometime in this time frame. Management on January 16 successfully also priced in a 40 million public offering of 8% senior unsecured notes due 2031. The underwriters have the option to purchase up an additional 6 million in aggregate principal amount of the senior notes, and this is with 30-day window from the date of the offering. So it might go all the way up to 46 million. You can take any conclusion of them as you want, but you should, it's an interesting fact that the They have been refinancing their debt and rolling it over at fixed rate. For MLCI, this is not the first debt rollover financed in recent years. Management did say this was an offering to mark an entry into the U.S. public fixed income markets, and the credit rating for those interested that was issued by a private entity, Agnar Jones, was BBB minus. Management has explicitly linked the issuance of new shares to its long-term strategy of a creative strategy growth and acquisitions. To me, this is a little worrying, as if they view the shares simply as currency to get deals done. When deals do get done, it could be amazing if done really well, but this seems to be rarely the case. In recent times, they have made these share-based acquisitions, including minority stakes in Runway Growth Capital in January 2025, Aviation in July 2023, and minority interest in Canadian Asset Manager in June 2023. The management has essentially built MLCI into a consolidator in the BDC and private credit. And they build this in the strategy of pipeline of acquisition opportunities aimed at scaling their fee business. As a result, the small allocation is dependent on good acquisitions, and there's a significant risk and dilution from bad ones. Recent records do show that they have some promise in this space, but I do have my reservations in any M&A business. This part will make a little more sense once I discuss the business model and why they need these acquisitions to grow. So let me give you some history about the firm. Just like we find nature evolving, we have businesses, even though they're an artificial construct, also evolving. And technically, I could start anywhere. I can even start at the previous history of the Canadian Mining Company, which was what MLCI was technically taken from. But I'll start at a point which makes more sense to me. And before I bore you with that, I'll spend a little time talking about the players, but not to worry, it's just about a sentence or two. So the CEO is Ted Goldthorpe, so he's the same individual who owns a big stake in the company, well, percent something. He's the CEO and chairman. His career is built on a 13-year stint at Goldman Sachs as a managing director of the Special Situation Group, where he ran the bank and loan and distressed investing desk. He also served as president of Apollo Investment Corporation, and it's important because this is much of the same playbook that MLCI is trying to do, and funded the credit platform at BC Partners. Henry Wang, the current co-president, also has a stint at Goldman, about 7 years, working both the Special Situation Group and the Investment Banking Division. He also works alongside Ted at BC Partners. The other co-president is Matthias Ederer, with a similar background to Henry, and there's Patrick Richards. There's also a few other executives, all with varying experiences. Some have American Express experience, Silicon Valley Bank, I think the CFO has experience. Others have the same Goldman experience and other, high head positions, head of global credit, stress investing, and head of Asia trading, et cetera, et cetera. So quite saturation in veterans and Goldman experience and other investment banking experience. These two do remember my special write-out about Logic Inc., so LOGC. Right now I think the ticker is LOGC.D because it has a special offering attached to it. Anyway, that business was financed by BC Partners. Here we kind of meet them again. And not only do they meet them again, we actually have the management is associated with them. So Mount Logan is a formally affiliated partner of BC Partner Advisory LP, BCPA, for U.S. regulatory purposes. The reason is that this affiliation enables close operational coordination between them and would otherwise be forbidden under the Investment Community Act. What this really means in plain language is that they have something called co-investing relief that allows them to participate and co-invest alongside BC Partners and affiliate funds in private deals. This basically means that they're part of the affiliation of BC Partners, 40 billion umbrella, and leverage that ecosystem for an edge against other competitors. The other relationship perk is a formal staffing and resource agreement that allows BC Partners to provide the personnel and resources required to execute the MLCI strategy. In recent one event that show a huge benefit from this situation is the BC Partners got MLCI out of quite the hole. Due to fraudulent employee impersonations, there was a wire transfer fraud, and BC Partners essentially guaranteed a portion of the funds to be recovered and took the loss on themselves, regardless whether the funds were recovered or not. I'll give a little more details in a sec, but another testament to the relationship, and I could be wrong here, but we could say that about 60% of MLCI's debt instruments portfolio consists of deals originated by BC Partners platform, notably the acquisition of Runway Growth Capital last year. A relationship runs in both directions, as both Ted and Henry are senior partners at BC Capital. Give me a second. Now, back to the actual business. If we take 2018 as a real starting point, and that's also the year where all the annual reports are from, and honestly, a chronological point where it actually makes sense, and we treat that as the start. In October 2018, the company completed a reverse takeover of Merit Resource Corp, listed on the Canadian NEO Exchange, now as the CBOE Exchange, and officially debuted as a public entity. At the same time, their plan of arrangement, they issued contingent value rights, CVRs, to shareholders of the old company alongside one share of the new entity, tied to future recovery of legacy assets and Klein Mining Corporation, a liability on their balance sheet for years. Now, instead of, just jumping, I'll just be honest with you. We're going to go chronologically, just some of the events that matter. You can feel free to skip this part, but essentially, so here we go. In February 2019, MLC, that was the old ticker, entered its first major debt facility. That was $50 million revolving senior loan facility for the purpose of funding its own portfolio. In October 2019, there was the unfortunate incident that I mentioned about the wire transfer fraud. Essentially, there was employee impersonation that led to 2 wire transfer totaling 1.6 million Canadian sent to 2 third-party accounts. MLC recovered about 2/3, so that was 1.06 million a few months later, with no material impact on liquidity, at least according to their statements. But the incident triggered a full review of internal protocol controls, and there was also a FBI internal police forensic investigation. BC Partners agreed to advance the remaining lost amount to MLC. MLC was under no obligation to repay this advance unless it recovered further funds from the thieves. So you can kind of see this BC partnership coming back and helping them out. So now we're in 2020. The growing concentration of operations south of the border, MLC changed its reporting to USD. MLC acquired a stake in Sierra Cross Investment Management, so SCIM, and in the first CLO, so collateralized loan obligation platform, acquired from Garrison Investment Management, totaling their CLO management to a few hundred million in AUM. So essentially that kicked off their fee business, which we'll see in a sec. In 21, MLC acquired Ability Insurance for $20 million, with an additional $10 million injection to kick off their annuities business, and became the investor advisor for Logan Ridge Finance Corporation. So this is essentially the start of their insurance business and growth of their fee business. In 22, MLC completed its Bluebird Lurel transaction to diversify its loan business and has a new advisory client, the Opportunistic Credit Interval Fund, OCIF. 2023 is a very pivotal year because this is the year they finally got rid of their CVR obligations. So New Elk Coal, NECC, the prominently as underlying the legacy Klein Mining CVRs, filed for bankruptcy, Chapter 11 bankruptcy. This allowed them an 82% write-off, and in October of the same year, the original CVR expired. The other notable thing that year was the acquisition of Aviation Fund Management, which helped add a Texas office and diversify into commercial lending and litigation finance for its portfolio. In 24, an 18.8 million capital raised through an 8-year debenture offering. Last year, MLC merged also with 180 Degree Capital Corp. Very ironic since we're 18 Degree Capital, not Capital, but 18 Degree Journal here, and they say 180 Degree Capital. But anyway, life is full of ironies. Ticker TURN. So that was listed on the NASDAQ. Merged with MLCI for, I believe it was a stock exchange between the two. One got, I think, 50 something. They got 40% of the company. And they merged the platforms. They also participated in the merger of the platform Logan Ridge and Portman Ridge to form a larger BDC platform. BCP Investment Corporation, BCIS, letting to write its legacy Logan Ridge contract, but it did gain a 16.03 profit sharing interest in that new entity. November marked the first 10Q order of the new entity, where we saw assets of $1.64 billion. Now, for those of you who just want to skim, I have a graph, so I will put it here for a second. You can pause, take a look. Basically, I put around with napkin and seeing if I can generate it real quick. So I wrote out what I wanted. It put it in a timeline. Pretty nice, and I think you should check it out. Not sponsored or anything. The current high level of the business model. So hopefully I didn't bore you too much with the history, and I'll give you a little more details. Don't worry if it doesn't make sense. I'll give an example at the end. So I alluded to this business model bit when I mentioned the acquisitions, and it's very possible engine of growth for the business, but you may have not really understood to why. So here's a simplified explanation of their businesses. You can think of it as 2 pillars, essentially. You have the asset management business, and I call this kind of the brain of the operation, and you have the insurance solution. So I wasn't too sure what to call it, but let's call it the muscles of the operations. So the brain, so the asset management business, and referred into the annual reports as the FRE. The business is part of the Golden Goose and is designed to be an asset-light operations with stable, predictable fees. In the reports, it's referred to as the FRE, which stands for the Fee-Related Earnings Business. I call this part of the brain, as it is the sole responsible for making all the decisions what to do about the loans. So what rating to loan, to originate the loans, to find who to lend it to. Essentially the one doing the work to create return for the other segment, which we'll get to. The muscle provides, which we will explain, the muscles provide about 1.1 billion here to manage. And the brain essentially goes and lends that money out, but they also lend out for third parties. So there's a few fees to collect. So we'll call it first fees, the origination transaction fees, and I call this the hunter's fee. So this is cash paid up front by the company that needs a loan, and this for the privilege of getting that loan. And this could be anywhere from 1% to 2%, and it has possible add-ons for depending on how it's structured, for the diligence necessary, and for the consulting fees. Then there's the management fee, and I call this kind of the base fee, and that's the recurring fee. So again, so we have the muscles fee of 1%, so that comes from an entity. Without going too much detail, essentially it's putting money from your left pocket to your right pocket if you look at the whole entity, but it is a fee that's consistently going to be paid. They also get a recurring fees of 1.75% from their BDCs of assets. And for other private companies that manage money for, or private funds, it's 1.5 annually, and I believe it's 0.125 monthly, paid every month. To manage them. They also have incentive fees. So if the loans outperform what they were supposed to, anything over a hurdle rate, they get to keep 20%. And they have a special clause that 20% needs to get filled. And that gives them a little bit more of a safety net and pure profit margins there. Perhaps an incentive to not just grow but give out good loans, but that's to be seen. Then they have others, admin and services fee, depending who pays, but it's very variable. This just to cover their filings, their tax reports, administration expense, etc., etc. So currently the business earns, if you clean out the mess, around 2.5 million. So this segment. Again, remember that a portion of that is just putting money from your left pocket to your right. Take that as you will, and the run rate is about 10 million for 2026. They also have got an equity kicker where they not only earn fees, but they also get a piece of the company they manage. So now the muscles, the insurance business referred as the SRE. This business is really what makes the whole thing kind of happen. It is the what, in the Bower's day, what's going to hold the business. So in the reports, you can see this referred as the SRE, which stands for the spread-related earnings. Those who are big fans of Warren Buffett will know his fascination with the floats. Well, just like other instruments, the muscle here is a special, almost permanent capital, mostly led by Ability Insurance, which is a reinsurer for mostly multi-year guaranteed annuities, MYGAs. And Jesus, I gotta say, the amount of acronyms here is quite the tongue twisters, and also to follow it when I was researching, I'll be honest with you, I gotta go and really look back what each one means. Anyway. If we really need to simplify the business is an insurer and reinsurer business with fixed payouts in return for capital lockups. And they earn money on the spread of what they lend versus what they get. So their whole profit margins are capital paid minus annuities paid. So this is what they earned, float capital earned, annuities paid. And the spread is the engine of their profits. So as long as they write the business well, the brain writes the business well, and they don't have to suffer losses, and they have enough of a call it a buffer, and they're within regulatory improvements, they get their fees, and the incentives here is to grow this as big as possible. Last quarter, the spread was only 12 basis points, but there's a huge goal and a push towards normalizing it to 75 to 100 basis points, and they blame that they have legacy cash and bonds that they will rotate into higher yield BC Partners originated credits that will push them that way. The business has also held swaps to protect the spread, and especially an insurance policy against the interest rates. My theory is they have this 187 million swaps because they've been struggling heavily with volatile interest rate environment, and I think most insurance companies have this just to normalize the earnings and to make sure they're hedged in case of extreme events. Again, same kind of principle. They got to build this. The bigger this base, the better the business, the safer there will be. And a fun fact before I give you the actual example, but if we leave management, everything goes well planned. If they do normalize this to 7,500 basis points, that for current 1.1 billion, that's about $8 to $11 million. So cumulative is about $20 million business earnings. Minus some expenditure, some administrative fees, but definitely something to keep in mind. So if you were confused, I kind of sketched here, I'll put it here. So maybe that was a little more confusing than it needs to be. Let's give you a scenario to make it a little bit more, sense. And you can look at the picture I've sketched. Hopefully, I asked someone to rewrite the writing, so it should be a little more legible. So let's say there exists a company called Help Me Corp. Help Me Corp has sold 100 million in insurance annuities, MYGAs, promises annual payments of about 5% for the next 5 years. Due to regulatory pressures or simple option activities, Help Me Corp is overextended and wants to remain a better position rather than keep making that promise. So they come to Ability Insurer, which is essentially the Muscles or MLCI's insurance arm, and ask them to take it off their books. Ability Insurer says no problem, give me the capital. So they take the 100 million, they guarantee the 5%. This is a reinsurance treaty between the two, and now Ability is responsible for the 5% payments and the principal. So they send the money to the brain to manage and try to get a yield over the 5%. The brain comes out, finds someone to write the loan to. For example, finds an infrastructure project at 8%. They loan that. They believe that the brain has this Goldman DNA. They have these huge experiences in private credits, and it allows them to write them better business because they actually write the loans, not borrow the money from somebody else or find the public contracts. The muscle pay the brain that 1% that we mentioned for this opportunity. And at the end of the year, let's say they earn the 8%, they send it to the muscle. The muscle receives it minus the fee and minus other small fees and earns on the spread. So if we have 8%, they paid the 1% for the fee, that's 7, minus the 5 they paid out, they made about 2% profit. And of course, some of this money is put away in case there's some bad loans written. But the goal is to grow this asset base and try to earn higher fees. The goal is to continue these operations with higher and higher permanent capital, and the advantage is that because they have multi-year lockups, they are in a safer place, because if they decide, or whoever has the annuities decides to draw, they have wide penalties, so the incentive is not to pull out. And MLCI is able to continuously rack this the flywheel of more and more capital and slowly compound over time. And now the brain, as I said before, can also go out to other lenders and manage other portfolios, and now it gets extra fees into it, and you can see it at the bottom of the picture. Hopefully that wasn't as confusing. You kind of got the showcase, how it works. So some of my last words, I wanted to say one thing, more like a rant. I could not imagine this company screening well at all. It's honestly a nightmare keeping up with some of these accounting changes. They changed from CAD reporting to USD, and then from IFRS 4 to IFRS 17, and then to US GAAP. This is if you keep in mind how insurance companies have report their statements, which is a little bit different than other companies, including all merger fees and one-time costs, which turns into quite a fun challenge. Honestly, I did learn a lot from it, so I am grateful in that sense, but it is definitely not something that will stand out as something that's very easy to do. Anyway, just wanted to get that off my chest, so excuse the rant. Here's how I got to this idea. Recently I've been looking at what to do with my cash. I did find that you can get sometimes lucky, and you can find treasuries maturing in less than 30 days, yielding sometime around over 10%. And of course, this annually. This is not. This is annual, not for the duration of the 30 days. However, this time I couldn't really find anything, so I went to look at the arbitrage opportunities and other exists instead of committing to anything on my watch list, because I don't quite like the price they're at right now, and I fell again against MLCI. The yield between the two arbitrage yield looked a little too attractive, and that means I knew the market was pricing in that they are prepared that it's going to be oversubscribed, and I just wanted to learn more about it. And when I started learning about the company, I decided that the arbitrage opportunity is a great exit, but the business in itself is actually quite the gem as well. I decided not to, I had a draft where I threw a bunch of numbers at you, try to confuse you, but even if we consider that, that this is a business worth 105 million, not super liquid, volume of under 100,000 shares traded daily, that it's most likely going to be oversubscribed to this offer, and I needed to know that I will be safe even if things go wrong, if I want to be left with this business. And after researching it and growing my own little thesis about what's going to happen, I do think that it's a business worth having, especially when you have the second possible exit, when they do the other 10 million tender. Like I said before, they do already approximately 10 million in their fee business. They could grow the other part of the business to 10 million. That's 20 million. It's about 5 times cash flow, future cash flow. And you can make that as you will. You can look over the numbers, and I know oversimplify that explanation, even the ending thesis, but you can draw your own conclusions. I do think it's something interesting to look at, and regardless, I know that this is going to expire soon, and many of you are not interested to find this later. I will post a post-mortem in February to see what happened and what I learned from this experience. And who knows, perhaps I would want to build more on this position or keep it. So follow up in February. Stay tuned. Hope everything's well. Cheers.